Stop everything you are doing right now. Close the other tabs. Put down your phone. This is not a drill. This is not speculation. This is not another theoretical discussion about what might happen someday in the precious metals market. This is happening right now. At this very moment, as I record this video, silver is trading at two completely different prices on opposite sides of the world. In Shanghai, on the Shanghai Futures Exchange, silver is trading at $125 per ounce. In New York, on the COMEX, silver is trading at $110 per ounce. That is a $15 gap. That is a 13% premium. That is a divergence that should be mathematically impossible in a functioning global market. Arbitrage is supposed to prevent this. Traders are supposed to buy where it is cheap and sell where it is expensive until the prices converge. But the prices are not converging. The gap is widening. The divergence is accelerating. And what this tells us about the state of the global silver market is so alarming that I had to interrupt my normal schedule to bring you this emergency broadcast. Ladies and gentlemen, this is Silver Storm Daily, and what you're about to learn will change everything you think you know about precious metals pricing, global trade flows, and the coming monetary reset. Let me start by walking you through exactly what is happening, because the mainstream financial media is not covering this. The major news networks are not explaining this divergence. The pundits on the business channels are not discussing why silver in China costs $15 more than silver in America. They are silent because they do not understand it, or they understand it all too well and are terrified of what it means. The Shanghai Futures Exchange is the largest precious metals futures market in Asia. It is where Chinese industrial buyers, Chinese investors, and Chinese sovereign entities price their silver exposure. The SHFE price reflects what the Eastern market believes silver is worth. The COMEX is the dominant precious metals futures market in the West. It is where the bullion banks set the benchmark price that dealers around the world use as their reference. The COMEX price reflects what the Western paper market believes silver is worth. Historically, these two prices have moved in lockstep. There have been minor differences of $1 or $2 due to shipping costs, currency fluctuations, and local premiums. But the arbitrage mechanism has always kept the prices roughly aligned. When the gap got too wide, traders would step in. They would buy silver cheap on one exchange and sell it expensive on the other, pocketing the difference and closing the gap in the process. But that mechanism has broken down. The arbitrage is not happening. And the reason the arbitrage is not happening is the single most important fact in the precious metals market today. There is no silver to arbitrage. The physical metal that would be needed to close the gap does not exist in sufficient quantities. The Western vaults are empty. The dealers are sold out. The refineries are backlogged. The mines cannot increase production fast enough. There is a physical shortage so severe that the normal market mechanisms have stopped functioning. The paper price in New York says $110, but you cannot actually buy physical silver at that price. The dealers are charging $20, $30, $40 over spot. The real price in America is already approaching the Shanghai price if you account for premiums. The divergence on the screen understates the divergence in reality. Let me give you the specific numbers that illustrate the severity of this situation. The COMEX registered inventory, the silver that is actually available for delivery against futures contracts, has fallen to under 12 million ounces. That is an all-time low. At current delivery rates, that inventory will be exhausted in less than 10 trading days. The LBMA, the London Bullion Market Association, is in similar condition. Their silver holdings have been draining for months as metal flows from west to east. The ETF holdings, the physical silver supposedly backing the paper shares, have been declining as authorized participants redeem shares and remove metal from the vaults. Every indicator of physical availability is flashing red. There is no silver left in the Western system, and without silver to arbitrage, the price gap between East and West can grow to any size. The $15 gap today could be a $25 gap tomorrow. It could be a $50 gap next week. There is no natural limit to how wide this divergence can grow because the mechanism that would normally close it, physical arbitrage, is inoperative. We are in uncharted territory. We are watching the paper silver market in the West disconnect from the physical silver market in the East in real time. And when that disconnection becomes complete, when the paper market loses all relevance to physical reality, the benchmark price will shift. Shanghai will set the global price. New York will become a sideshow. The power that the Western bullion banks have exercised for decades, the power to set the price through paper manipulation, will evaporate. They will be screaming into the void, selling paper contracts that nobody trusts, while the real price is determined by physical supply and demand in Asia. Now let me explain why this is happening and who is responsible. Because this divergence did not occur naturally. It is the result of decades of manipulation colliding with years of physical accumulation. The Western bullion banks have suppressed the price of silver for 40 years using paper contracts. They sold silver they did not have. They created an illusion of abundance by flooding the market with derivatives. For every ounce of physical silver in existence, there are hundreds of ounces of paper claims. This leverage allowed them to control the price. When the price rose, they sold more paper to push it back down. They conditioned an entire generation of investors to believe that silver could never break out. They made fortunes betting against the metal while the stackers accumulated in silence. But the Chinese were watching, the Russians were watching, the Indians were watching. The Eastern nations understood what the West was doing. They understood that the paper suppression created a buying opportunity. They accumulated physical metal year after year while the Western paper pushers mocked them. They built stockpiles. They secured supply agreements with mines. They constructed refineries and processing facilities. They prepared for the moment when the paper game would end and physical reality would reassert itself. That moment has arrived. The East has accumulated so much physical silver that there is not enough left in the West to maintain the paper charade. The COMEX cannot deliver. The LBMA cannot deliver. The ETFs cannot back their shares. The paper claims are being exposed as fiction, and the fiction is collapsing. The $15 premium in Shanghai is not a random market fluctuation. It is the price of reality. It is what physical silver actually costs when you cannot source it from depleted Western vaults. The Chinese industrial buyers need silver for solar panels. They need it for electronics. They need it for electric vehicles. They need it for the manufacturing empire that has made China the factory of the world. They cannot build their products with paper contracts. They need the metal, and they are willing to pay whatever it takes to get it. $125 is not the ceiling. It is the current price in a shortage that is getting worse. If the shortage intensifies, the Shanghai price will go higher. 150, 200. There is no natural limit when demand is inelastic and supply is constrained. Meanwhile, the Western price is lagging because the Western price is still set by the paper market. The COMEX price reflects what traders believe or pretend to believe that silver is worth. But those beliefs are being tested. The gap between belief and reality is becoming too large to ignore. The industrial buyers in the West are facing the same shortage as the buyers in China. They cannot source metal at the COMEX price. They have to pay premiums. They have to wait for delivery. They have to compete with Eastern buyers who are willing to pay more. The strain is showing. The system is cracking. Let me walk you through the specific mechanisms that are driving this divergence. The first mechanism is the collapse of the carry trade. For years, traders have profited from the gold and silver carry trade. They borrow metal cheap in one location, lease it out, collect interest, and return it later. This trade depends on abundant supply and stable prices. When supply is scarce and prices are volatile, the carry trade becomes dangerous. The traders are unwinding their positions. They are returning borrowed metal to their lenders. They are exiting the market. This unwind is reducing the amount of metal available for arbitrage. The traders who would normally buy in New York and sell in Shanghai are stepping back because they cannot source the metal to execute the trade. The second mechanism is the breakdown of the authorized participant system for the ETFs. The ETFs, like SLV, are supposed to track the price of silver by holding physical metal in vaults. The authorized participants, which are the big banks, create and redeem shares based on demand. When demand is high, they buy metal and create new shares. When demand is low, they redeem shares and sell metal. This system keeps the ETF price aligned with the spot price. But the authorized participants are now draining the ETFs rather than filling them. They are redeeming shares and removing metal from the vaults. Why? Because they need the metal for other purposes. They need it to meet delivery obligations on the COMEX. They need it to satisfy industrial buyers. They need it to ship to Asia where the price is higher. The ETF metal is being cannibalized to fill holes elsewhere in the system. This cannibalization is reducing the physical backing of the ETFs and contributing to the shortage that is driving the price divergence. The third mechanism is the currency war that is accelerating the flow of metal from west to east. The dollar is weakening against the yuan. Chinese buyers can acquire dollars cheaply and use those dollars to buy silver in the Western market. They are arbitraging not just the silver price, but the currency as well. Every dollar they spend on Western silver is a dollar that is worth less tomorrow. They are converting depreciating paper into appreciating metal. This trade is one way. The metal flows east. It does not come back. The West is being drained of its silver to satisfy Eastern demand, and the weakening dollar is accelerating the drain. The fourth mechanism is the industrial panic buying that we have been tracking for months. The solar industry alone consumes over 100 million ounces of silver per year. The electric vehicle industry is adding to that demand. The electronics industry is competing for the same supply. These industrial buyers have seen the shortage developing. They have seen the premiums rising. They have seen the delivery delays extending. And they have concluded that they need to secure supply at any cost. They are hoarding. They are building inventory buffers. They are signing long-term contracts that lock up future production. This hoarding is removing metal from the spot market and exacerbating the shortage. The more they hoard, the tighter the market becomes. The tighter the market becomes, the more incentive there is to hoard. It is a self-reinforcing cycle that is spinning out of control. Now let me connect this divergence to the broader monetary crisis, because the two are inseparable. Silver is not just an industrial commodity, it is a monetary metal. It has been money for 5,000 years. When confidence in fiat currencies erodes, when central banks print trillions of dollars to bail out failing systems, when inflation eats away at purchasing power, people turn to silver as a store of value. The current monetary crisis is the most severe in at least a century. The debts are unpayable. The currencies are being debased. The banking system is fragile. The geopolitical order is fracturing. In this environment, the demand for real assets, for tangible stores of value, is exploding. Silver is absorbing some of that demand. The price is rising not just because of industrial usage, but because of monetary preference. People are choosing silver over dollars. They are choosing silver over bonds. They are choosing silver over bank deposits that could be frozen or bailed in. This monetary demand is layered on top of the industrial demand, creating a perfect storm of buying pressure that the depleted supply cannot satisfy. The Chinese understand this better than anyone. They have been quietly de-dollarizing for years. They have been accumulating gold in their central bank reserves. They have been encouraging their citizens to buy precious metals. They have been building a financial system that does not depend on the dollar. The premium in Shanghai is not just about industrial demand, it is about monetary demand. The Chinese are pricing silver as money, as a strategic reserve asset, as a hedge against the collapse of the dollar-based global financial system. They are willing to pay $125 because they believe silver will be worth far more when the reset occurs. The $15 premium over New York is an investment in the future. It is a bet that physical possession will matter more than paper claims when the system finally breaks. So, what happens next? Where does silver go from here? Let me give you 3 scenarios based on the current trajectory. Scenario 1 is convergence upward. The COMEX price rises to meet the Shanghai price. The paper market capitulates. The shorts cover at any price. The Western benchmark catches up to the Eastern reality. Silver in New York goes to $125, then continues higher as both markets move together. This is the best-case scenario for Western holders because it means the paper market survives, just at a much higher price. Your COMEX futures contracts remain valid. Your ETF shares retain their value. The system bends but does not break. This scenario requires the Western vaults to somehow find metal to deliver. It requires the authorized participants to stop draining the ETFs. It requires a sudden increase in supply that satisfies both Eastern and Western demand. The probability of this scenario is declining by the day as the shortage intensifies. Scenario 2 is divergence and bifurcation. The paper market in the West becomes completely disconnected from the physical market. The COMEX declares force majeure. Futures contracts are settled in cash at a price determined by the exchange, not by the market. The ETFs suspend redemptions. The authorized participants stop creating shares. The Western paper silver market effectively dies. Meanwhile, the physical price continues to be set in Shanghai and in the physical markets where metal actually changes hands. We end up with 2 prices for silver, a fictional paper price that nobody trusts and a real physical price that everyone wants. This scenario creates chaos but also opportunity. Those holding physical metal benefit enormously. Those holding paper claims face losses as their contracts are settled at artificial prices. The transition is messy, but the end point is a market that is honest about physical reality. Scenario 3 is intervention and confiscation. The divergence becomes so destabilizing that governments step in. The U.S. government invokes emergency powers to seize silver for strategic purposes. The COMEX is nationalized. The ETF assets are requisitioned. Private silver is confiscated at a price set by the government, far below the market price. This scenario is the nightmare that silver stackers fear. It is possible because the legal powers exist and because governments have confiscated precious metals before. But it is also the most difficult to execute because the silver is dispersed, the political opposition would be intense, and the international implications would be catastrophic. A confiscation would confirm to the world that the US is desperate, that the dollar is failing, that property rights mean nothing. It would accelerate the flight from the dollar rather than restoring confidence. The probability of this scenario is real but hopefully limited. The most likely path forward is a combination of scenarios 1 and 2. The paper price rises significantly as the shorts are forced out. The physical premium persists because the shortage is real. The divergence narrows but does not disappear. The market becomes more honest about the physical constraints but remains dysfunctional. Eventually, the physical market takes over completely, but the transition is gradual rather than instantaneous. Throughout this transition, the price trends higher. 150, 200, 250. The exact numbers depend on the severity of the shortage and the pace of the monetary crisis. But the direction is clear. Let me now talk about what this divergence means for you specifically. If you hold physical silver, you are in the best possible position. Your metal is priced at the physical price, not the paper price. As the paper market disconnects from reality, your holdings become more valuable relative to paper claims. You have no counterparty risk. You have no delivery risk. You have real wealth that will retain purchasing power regardless of what happens to the financial system. Do not sell your physical silver to capture the current gain. The divergence is telling you that the shortage is real and getting worse. The price is going higher. Selling now would mean trading a scarce physical asset for abundant paper currency that is being printed into oblivion. If you hold paper silver, whether through futures contracts or ETF shares, you need to understand the risks you face. The paper market is under stress. Delivery failures are possible. Force majeure is possible. Your paper claims could be settled at prices that are far below the physical market price. Consider converting some of your paper exposure to physical. Take delivery on your futures contracts if you can. Redeem your ETF shares for metal if the prospectus allows. Move from paper to physical while you still can. The window for conversion is closing as the vaults empty. If you do not own silver, the divergence is screaming at you to buy. Yes, the price is higher than it was a year ago. Yes, the premiums are elevated, but the divergence is telling you that even $110 is cheap relative to the real market price in Shanghai. The Chinese industrials are paying $125 because they know something you might not know. They know that silver is running out. They know that the shortage is structural. They know that prices are going much higher. Buy physical silver now, pay the premium, accept the delivery delay, get metal in your hands before the window closes completely. Let me address the question that everyone is asking. How high can silver go? The honest answer is that I do not know. Nobody knows. The price depends on variables that are inherently unpredictable. How severe will the shortage become? How fast will the monetary crisis accelerate? How will governments respond? What new sources of demand will emerge? What supply disruptions might occur? These questions cannot be answered with precision. But I can give you a framework for thinking about price targets. The first framework is the inflation adjustment. Silver reached $50 per ounce in January 1980. Adjusted for official inflation, that is approximately $190 in today's money. Adjusted for real inflation, which is higher than the official numbers, that is approximately $300 to $400. So far, silver has not even reached its inflation-adjusted high from 45 years ago. By this measure, silver at $110 is still cheap. It has significant room to run just to reach parity with its previous peak. The second framework is the gold-silver ratio. Gold is currently trading around $3,200 per ounce. The gold-silver ratio at current prices is approximately 29. Historically, the ratio has averaged around 15 to 20. If the ratio compresses to 15, silver would be priced at $213 per ounce. If the ratio compresses to 12, which was common in earlier centuries, silver would be priced at $267. If the ratio compresses to the geological ratio of 8 to 1, which reflects the relative abundance in the Earth's crust, silver would be priced at $400 per ounce. These are not fantasy numbers. They are mathematical derivations from historical and physical relationships. The third framework is the monetary reset scenario. If the global monetary system collapses and is replaced by a system that includes precious metals as reserve assets, the price of silver would be reset based on the amount of currency that needs to be backed. The math is staggering. The total global money supply, broadly defined, is over $100 trillion. The total above-ground silver supply is approximately 2 billion ounces. If silver were to back just 10% of the global money supply, the price would be $5,000 per ounce. If it backed 1%, the price would be $500 per ounce. These numbers seem insane from the perspective of current prices, but they are the mathematical reality of a monetary reset. I am not predicting any specific price target. I am showing you the range of possibilities. Silver at $110 is at the low end of reasonable valuations. Silver at $300 is in the middle. Silver at $1,000 or higher is possible in a monetary reset scenario. The divergence between Shanghai and New York is telling you that the market is waking up to these possibilities. The Chinese are buying at 125 because they see the potential for much higher prices. They are not buying for a quick trade. They are buying for strategic positioning. They are building reserves that will give them advantage in the monetary system of the future. Now let me talk about the implications for the mining sector, because the divergence creates extraordinary opportunities for silver producers. A silver miner has relatively fixed costs. It costs roughly $15 to $20 per ounce to extract silver from the ground, depending on the deposit. At silver prices of $110, the profit margin is $90 per ounce. At $125, the margin is $105. These are extraordinary margins that transform the economics of the mining business. A mine that was marginally profitable at $30 per ounce is now generating cash flows that rival the most profitable businesses on the planet. The market is only beginning to price this in. The mining stocks have risen, but they have not risen nearly enough to reflect the new reality. The junior miners in particular are dramatically undervalued relative to the cash flows they will generate if silver remains above $100. This is where the asymmetric opportunity lies. Physical silver will perform well, but the miners could perform spectacularly. The divergence also has implications for the energy transition. Silver is essential for solar panels. Every gigawatt of solar capacity requires millions of ounces of silver. The world has committed to a massive expansion of solar energy as part of the climate transition. But if silver costs $125 per ounce or higher, the economics of solar become challenging. The cost per watt increases. The payback period extends. The competitiveness with other energy sources diminishes. The governments that have mandated solar expansion will face a choice. They can pay the higher price and accept the increased cost. They can reduce their solar ambitions and miss their climate targets, or they can find ways to substitute other materials, which would reduce efficiency. None of these options is attractive. The silver shortage is going to force a reckoning with the unrealistic timelines that policymakers have set for the energy transition. The geopolitical implications are equally profound. Silver is now a strategic resource as important as oil or rare earths. The nations that control silver production, primarily Mexico, Peru, and China, have leverage that they are only beginning to understand. The nations that consume silver for industrial purposes, primarily China, the United States, and Europe, are in competition for a limited supply. This competition will intensify as the shortage deepens. We could see export restrictions, strategic stockpiling, and resource nationalism in the silver market. The precedents are already there in other commodities. Indonesia has restricted nickel exports. China has restricted rare earth exports. Silver could be next. A producing nation that decides to keep its silver at home, to reserve it for domestic industries or to build strategic reserves, would tighten the global market further. The divergence between regional prices would widen. Let me bring this back to you and your portfolio. The divergence between Shanghai and New York is the most important signal in the precious metals market today. It is telling you that the physical shortage is real, that the paper market is failing, and that prices are going dramatically higher. This is not a time for hesitation. This is not a time to wait for a pullback. The pullback may not come, or if it comes, it may be from 150 back to 130, still higher than today. The risk of waiting is missing the move entirely. Every ounce of physical silver you can acquire now is an ounce that is priced at the Western paper price rather than the Eastern physical price. As the markets converge, as the paper price catches up to physical reality, your ounce will be repriced higher. You are arbitraging the divergence simply by holding physical metal. The Chinese industrials are doing this arbitrage at the national level. You can do it at the individual level. The mining stocks offer leveraged exposure. If silver doubles, the miners could triple or quadruple. The operating leverage in a mining business means that profits increase faster than revenues when prices rise. A silver miner with a $20 cost base makes $90 of profit at 110 silver. If silver goes to 220, the profit is $200 per ounce, more than doubling on a price doubling. This leverage works in both directions, so the miners are riskier than the metal, But if your thesis is that silver is going higher, the miners offer the best risk-reward. The ETFs are the least attractive option right now. They are being drained by authorized participants. They may face redemption halts. Their tracking to the physical price is degrading. If you must hold paper, futures contracts with delivery capability are better than ETF shares. But physical metal in your possession is better than either. I want to close with a message about what this divergence represents on a deeper level. For decades, the Western financial system has operated on the premise that paper is as good as physical, that a futures contract is as good as an ounce of silver, that an ETF share is as good as a bar in your hand, that the nominal price on a screen represents real value. This premise was always a lie. It was a convenient fiction that allowed the banks to suppress prices, that allowed the paper market to dominate the physical market, that allowed claims on resources to multiply far beyond the underlying resources themselves. The divergence is the death of that lie. The $15 gap between Shanghai and New York is the market declaring that paper is not as good as physical, that a COMEX contract is not as good as an ounce of silver, that the screen price is a fiction while the physical price is reality. This declaration has consequences that extend far beyond the silver market. It calls into question every paper claim in the financial system. If silver paper cannot be trusted, why should gold paper be trusted? Why should bond paper be trusted? Why should currency paper be trusted? The divergence in silver is a crack in the foundation of the entire fiat financial system. The Chinese understand this. That is why they are paying $125. They are not paying a premium for silver. They are paying for reality. They are paying for something that actually exists, that cannot be printed, that cannot be counterfeited, that cannot be defaulted on. The premium is the price of escaping the paper matrix. It is the cost of admission to the physical economy. It is cheap at twice the price. The question is whether you will pay that price while you still can. The divergence will not last forever. Either the paper price rises to meet the physical price, or the paper market collapses entirely. Either way, the opportunity to acquire physical metal at paper prices is closing. The window is narrowing. The clock is ticking. This has been Silverstorm Daily. Silver is trading at $125 in China and $110 in the United States. The divergence is real. The shortage is real. The paper market is failing. The physical market is taking over. The price is going higher. Much higher. The only question is whether you will be positioned to benefit, or whether you will be left behind holding paper promises that cannot be redeemed. Like, subscribe, and share this video with everyone who needs to understand what is happening. The emergency is now. The opportunity is now. The time to act is now. See you in the next report.